we are set up for. Agam, the number of things that can happen in 24 to 48 hours. A war on the horizon, flaring up. SEBI coming and sort of shaking the whole F&O system by the shoulders. And all of this now panning out from an Indian market perspective.
Tamanna, I'm going to try and give levels, but I think it's not going to be so important. The first one or 2 hours is going to be a little bit more important in terms of the kind of sentiment that we can expect in the markets. But I reckon that to a certain extent, it's what's happening in West Asia is going to be more important today.
Yeah, absolutely. Look at some of those pictures that have come over the last 24 hours. So Iran lobbing 180 ballistic missiles into Israel. Israel saying that the response will be painful, quote unquote, and no one really knows what's going to happen next. Meanwhile, Israeli troops are already in Beirut, in Lebanon, and this looks like something which could really flare up. So a lot of things up in the air and a lot of uncertainty really dominating what's happening with markets today. But let's look at the global setup very quickly and what happened in US trade. Remember, we were shut on 2nd October, but the US markets were not. So they had the 2nd October cycle to react to Iran and Israel. They ended completely flat. Those fears definitely are there, but the key benchmark indices ended flat in trade yesterday. Futures are slightly down. What the US markets will also look at is non-farm payroll data, which will come up on Friday. That becomes very, very important. The private data cut for the same set of numbers, which is jobs, was pretty positive, so that's one to look out for. Meanwhile, bond prices are inching higher, waiting for that data, and also because of the Iran-Israel tensions. So you have the 10-year also moving steadily higher at 3.79%. Crude, though, of course, becomes the big story, and becomes the big story simply because on one hand you have more supplies coming in with OPEC Plus expecting to increase production. Despite that, you have Brent at nearly $75 a barrel. The NYMEX up 1% as Iran has made these moves. Let me just quickly take you through what exactly has happened on the global front and in that crisis. Israel has now vowed a painful response to Iran's missile strike. Iran had launched 180 ballistic missiles at Israel. This is, of course, after Israel's action against Hezbollah leaders. They were killed. The fear is now growing that Israel could target Iran's oil infrastructure in these retaliatory attacks. Having said that, Iran has 3 to 4% of global crude production, which is why the response you're seeing on crude prices is relatively muted, I would say. Meanwhile, Asia has its own story going on. Look at the Nikkei this morning. The yen has crashed quite a bit versus the dollar. Nikkei up 2%. Hang Seng seeing some pain, of course, they're about 3.5% down. But Nikkei also up because of what the Japanese Prime Minister has come out and said. Ishiba came out and said that there's no case for another rate hike right now after he met the Bank of Japan chief. Remember, that was one fear as far as he's concerned. Now, having said all of that, what is it looking like for India? Let me pull up the implied open because that's the big story for us, and it's looking like a tough day. 268 points down on the Nifty implied open, and could be domestic factors more than global maybe as far as we're concerned. But having said that, let's get a check on what we could expect going forward. Peter Maguire is joining us. He's CEO at XM Australia. Peter, very good morning to you from where we are. Pleasure as always to speak with you. What are you making of the kind of conflagration we've seen between Iran and Israel from a market's perspective? And I'm not talking about the war itself or the geopolitics of it, but from a market's perspective, how much of a concern is that Iran's crude supplies or entire oil machinery will get hit?
Well, good morning, Tamanna. I think we've been down this pathway before, and this really creates much angst from a supply side if there was to be an attack on those Iranian fields. We all understand geographically where they're positioned in the Strait of Hormuz on the Persian Gulf, and the impact that would have to shipping and, of course, all the crude that flows through that region. So this would derail, in a lot of ways, a lot of crude being exported globally. So there's the first part. And the second part is a war premium would be quickly built into price, and that could add $5, $10, $20, depends on the severity of it, very, very quickly, if not more.
Right. Peter, morning. There were some reports over Tuesday and Wednesday as well, but there was some speculation with respect to OPEC going ahead and increasing production going ahead. Of course, since then, we've had certain stories being rebutted. And this was a Wall Street Journal story being rebutted by the OPEC. There was still speculation that oil prices could potentially go down to $50 a barrel. That looks unlikely, yes?
Well, Agam, I'd have to say good morning. I think a couple of things. First off, if you've got these, there are two very different processes in play. You've got, if you strip out the war and there was nothing happening and you were going to increase production, you would think that prices would fall in value. But now you've got a war premium that could be built in and escalating, and you've got major conflict across that Mideast basin. So that creates uncertainty, and uncertainty is not what the markets like. The markets want certainty. So these are all factors that are going to, I think, unwrap themselves over the next matter of days.
To understand, the impact that Iran has on global crude supplies, the war and the uncertainty there, of course, remains. But the fact is that Iran is not such a huge supplier by itself, and the fact that there's a glut. Do you think that tempers down expectations to some extent, or tempers down at least the impact of this war on crude prices?
Well, Tamanna, it depends if there was a severe strike on the actual oil refineries and the whole Iranian oil, the complex pipelines and everything that goes into the production of oil. So there's the first part. So if they were to take out their infrastructure, that would create much angst, because naturally, are they going to be their counterparts or their allies coming to their support? And then the next part of it is what happens as far as distribution through the Persian Gulf. So, these are factors that can quickly escalate, and we've just got to see how severe that particular process or scenario was to play out. This is all unknown because this is going to be into the future, and we've just got to sit here and see what the retaliatory action is going to be from Israel.
Moving on to, well, I'm going to talk about metals in this case, because we've actually seen a lot of policy traction with respect to what China is doing there. And because of that, we've actually seen a little bit of resurgence in metal prices as well. How are you reading into things here?
Well, Agam, you've got copper now through 10,000 a metric ton. It's bounced very strongly to the upside. So is aluminium, nickel, tin, zinc. So all of them have had a really nice rally, and it's on the back naturally of that China stimulus. And are we going to see that ongoing? The stock market has been mind-blowing, what you've seen for the performance in September, and certainly over the last week and a half across the Chinese equity markets. So if this is going to be the pathway forward, and you're going to see continued uplift and really a concentrated effort from a stimulus perspective as far as China's concerned, then that's a good sign, because but you naturally need to see consumption out the other side. That's global consumption. So again, it's early days, but at the moment, it's been a market that many traders have enjoyed terrifically in the sense of base metals and that quite bullish move to the upside.
All right, thank you so much for that, Peter McGuire there. And, a lot of uncertainty out there, but remember that the kind of impact we will see from the Iran-Israel conflict, at least on crude prices, will be limited because of the huge glut in supply. And also we'll have to wait and see. I think what the market is waiting to see is what exactly is the shape and form of Israel's retaliation. Having said that, war, and another war looming is going to be one overhang, even as domestic factors settle.
Yeah.
Though for today, I suppose, Agam, the story that you've been on all of yesterday through the holiday is what SEBI has finally come and done on F&Os.
Yes, Tamanna, it's something that we weren't expecting. Sure, we were expecting that to come through a circular, but not as soon as, it did. That was on Tuesday evening. But let me very quickly go through once again as to what were the latest updates with respect to the SEBI crackdown on the futures and options space, starting off with upfront collection of option premium. There has been a little bit of an exercise that plays out where when it comes to buying options, a lot of these traders use broker collateral, but that will no longer be in place, and a lot of these traders will in fact have to go and produce funds if they in fact do want to go ahead and buy these options. There will also be a removal of calendar spreads. Calendar spreads is basically nothing but buying a certain option in one expiry and selling the same option, same strike in another expiry. And this is a hedge position which actually leads to a lower margin requirement, but that is being expunged when it comes to expiration contracts. That is, on the day of expiration, you will not be able to take calendar spreads. This is, of course, a positive because it just reduces the risk on the system on an overall basis. Intraday monitoring of positions, again, this is something that, SEBI had in mind, but it wasn't really being taken seriously. And what really happens is on an intraday basis, a lot of traders, in fact, go ahead and take positions beyond permissible limits. But if you, in fact, do have the monitoring of these position limits, that will also be curtailed, thereby once again reducing risks not only for traders but also for the system as a whole. Contract size, and that's where we're going to see an increase in contract size, and this was perhaps on expected lines because we've actually seen markets go up substantially over the course of the last 10 years, and since 2015 we really haven't seen too much change in your overall notional value of contracts, and I reckon that that's just coming in line, coming in par with the general standards that SEBI needs to keep. And at the moment, of course, that notional value will go from 10 lakhs to 15 lakhs and eventually down the line to 20 lakhs. But perhaps the biggest of them all, and this is something that is going to hit a lot of players up their chin, is going to be the rationalization of weekly, derivatives contracts. And this is something that Tamanna is going to take forward as well. But what this means is that currently we have about 7 very actively traded weekly options expiries, and this is going to come down to 2 between the NSE and BSE. Each will have just one benchmark which will have that weekly options expiry. This is going to mean potential loss of revenues for not just the exchanges like BSE, but also many other brokerages, specifically those who are dealing with discount broking houses. That would include something like 5paisa, Angel One, or IFS Securities for that matter. And finally, an increase in tail risk coverage, again more or less to do with keeping risk in the system in check, and it's just one of those things which was going to require a lot more margin in general. But overall, while most of these measures will have very little impact when it comes to brokering houses or exchanges, that one rationalization of weekly options is going to be the big one, and that perhaps alone could potentially lead to weakness, at least in today's day of trade, for a lot of these stakeholders here.
Absolutely. Now, the big question is what is going to be the impact, Agam, and it could be anybody's guess, but from what I am learning from very reliable sources is that trading volumes in this segment on exchanges could drop as much as 50%. It's possibly going to be, if that's, put it this way, 50% say for NSE, which has larger volumes. The impact on BSE, which is the listed player, is likely to be even higher in terms of trading volumes of their derivatives offerings. This is after the SEBI regulations kick in, of course. The assessment is 50 to 60% of traders will drop out as a result of those higher contract sizes and the rationalization of weekly expiries. Your upfront margin also increases. And what the statistics show you right now is that most of them will end up just dropping out, perhaps. In the couple of conversations I had yesterday, the sense was that people who wanted to come into this because they liked the speculative part of it, which is what the regulator wants to crack down, will then find that a means. They'll maybe go into dabba trading or other things like that, but maybe they'll get squeezed out from here. I think the most important point, though, is which benchmark will be chosen. It seemed apparent because the SEBI circular says that one exchange, one benchmark expiry, but the jury's still out on that. So for everyone who is trading the bank Nifty as a weekly expiry, and of course that's most of the volumes going there, that is still up in the air. The primary move or the exchange NSE could be looking at Bank Nifty as an option if they can. It's not necessarily that they'll go in only for the Nifty. So that becomes very, very important. I think one other point that really came across strongly in my conversations is that the regulator could take further action if trading volumes don't really come down as much as we're talking about, which is 40 to 50%, because this is exactly the aim. So that hammer will keep hitting till the nail is in its place. Was how it was also described to me. So Sajid is joining in this conversation with a smile on his face. Sajid, the point is that what will be the impact on some of these exchanges and brokerages? Few of them listed, of course, but all of these volumes also driving profitability hugely for them.
True. If you look at just pure statistics here, the total volumes of Bank Nifty, which was an average daily turnover, was around 48.6%. And this is for the calendar year to date, means from Jan to August. We're taking a daily average there. And if you look at the open interest for the Bank Nifty, it's coming to around 35%. So clearly, a lot of speculation was in play as far as Bank Nifty is concerned. And Bank Nifty is the thing which is getting targeted by the regulator as well. Nifty 50, my understanding is that the regulations or the circular is very clear. It says benchmark index for one benchmark index per exchange, and for Nifty NSE it could be Nifty 50, and for Sensex for BSE it is Sensex 30. And the reason I say that is that classification of the indices is very clear. That when you talk about benchmark, it's Nifty 50. When you talk about sectoral index, it comes to Nifty Bank. So it's not sectoral indices or any indices. It says very clearly benchmark index.
And what I'm learning is that there will be pushback on that.
There could be a pushback.
There will be pushback because so what was BSE really seeing a lot of interest in?
BankX.
BankX, that Nifty, NSE takes Nifty and then BSE gets BankX and then everyone's happy.
I think both of them are not going to get that.
No one is going to get that. And so basically traders will have no opportunity to trade on the banking index.
True. So from a turnover point of view, you are right. What you have found also, because if you look at the total turnover, Nifty 50 has only 36% of the average daily turnover. So we are talking of potentially up to 60% of the turnover getting hit because of this weekly index, weekly expiry being going off. So there's only one index which is there. And I'm talking about NSE because the statistics are available only for NSE and not for BSE. And that's the reason I'm only talking of NSE here. On an open interest basis, which is the kind of liquidity which we see in the market, Nifty has a higher open interest of nearly 58% as compared to any other indices there. So we are looking at roughly 60% of the open interest getting will be excluded from November 28 when the weekly expiry or weekly indices new format comes into play there. It is also a very important thing to understand that when we say that 40 to 50% of the retail investors will go out, why we are saying so? That the reason being that the average ticket size, which is including the premium on options, is around 5,550 rupees.
Correct.
Now that goes up to 20,000 rupees, and the assumption is that because it goes to 20,000 rupees, the fringe investors who are coming and taking one contract or two contracts or something,
which is most in terms of numbers is a lot.
Half of them actually, because they are just testing the waters and saying jayega to 5,500 rupees jayega, that kind of stuff, which is the thing. So that's what are going to go out, because now the bet has to be higher. You add to that the transaction cost which has come into play, that is around 30% increase in transaction cost, because index option to label cost
came in from 1st
October, and that went up by 18% out for NSE and 10% for BSE, plus STT charges for index options have also gone up from October 1st. So around 30% of transaction cost has gone up. So it becomes very difficult for a retail investor.
So prohibitive entry barriers. Expect that to hit volumes and expect that to hit sentiment today. Thank you so much for that, Sajid.
Yeah.
Yeah, and Agam, let's get on to what the trade setup is looking like.
Yes, so of course, while we're watching out for a lot of these companies, I'm going to start off with the benchmarks themselves. So firstly, remember that the Nifty has come off from, well, the levels of around 26,300. It hasn't hit that, but your life high was around there. And now it will be closed below 25,800. And at the moment, given today's expiry, given today's potential weakness, the important mark on the higher end is 26,000, where there's a resistance. That one perhaps is the easier one to call out. On the lower end, a tough level to watch out would be 25,600. Why? Because 25,587 to be precise is your 20-day exponential moving average. And that will provide you with a little bit of support. But if you break that, you also have a significant amount of writing around puts where it comes to 25,500. So 25,500, 25,600 is your 100-point support range in today's geo trade, and that's what we're going to watch out for and keep an eye on as far as the Nifty is concerned. What is really, really interesting, one, the VIX is trading at a near 3-month low. It's below the mark of 12. That means that there's a potential that this is likely to rise, and that will lead to a substantial change in option premiums. The other thing which is very interesting is when it comes to FII positions in index futures, that stands at 80% longs. Because of the fact that this number is very, very large in terms of longs, and the fact that you could see a little bit of unwinding coming through, that unwinding itself could lead to a lot more weakness because of the kind of longs that are there into the system as far as FIs are concerned in the index futures go. So these are the two of the factors that could potentially weigh on indices today. And as I have suggested, that the first couple of hours will be crucial in determining the way in which we see the markets fare. And you would sure enough, you do see a sharp cut in your Nifty applied open, but we must also remember that yesterday was a holiday. So to a certain extent, that sharp 225 odd point decline right now is also factoring in the potential that could have been a part of yesterday's day of trade. So that's the other thing to keep in mind. Watching out for 25,600 on the index for now, Tamanna.
Yeah, absolutely. It's going to be a tough day of trade. And remember, it wasn't too great on the 1st of October either. We ended pretty much flat. And, just to recap, a lot of volatility there. We ended up decently compared to all of that, but the implied open indicating a very, very rough start of the day. Big reason for that, of course, some of the action that SEBI has taken. Having said that, let's tell you some of the stocks that we need to keep in mind. And discount brokers will definitely have a rough day. So let's start with that. You look at an IFL, look at a Angel One, look at a 5 Paisa. They might get the rough end of the stick specifically because of what the SEBI action is. Look at a BSE because needless to say, if nearly half your participants in one segment which has been booming just leave because of the new kind of rules coming in, you're going to have an impact on revenue. So, in fact, a note out which has come in as well on what kind of an action we could be seeing thanks to this, and important to look at that because Jefferies has come out and said that the circular is broadly in line with their discussion paper and impacts 35% of industry premiums. What we are learning is 50% of volumes is what will be impacted. Lot size and margin hike, though, according to Jefferies, is lower than expected. Phased implementation will lead to calibrated tightening. Focus now moves to participant behavior post-implementations. Discount brokers can be most impacted, followed by exchanges. AMCs, wealth managers, and depositories remain unaffected. So that's important. A CDSC, CDSL, maybe a Nuvama, all of the wealth managers will relatively be fine. So that's one lot of stocks definitely to watch out for. The other one are the FMCG players. So some of those business updates coming in. Dabur and Marico gave their Q2 business updates yesterday when markets were shut. For Dabur, it's not looking too good. Heavy rains and floods impacted consumer offtake in Q2. This is what the company said. The beverage category saw some impact due to these factors as well. The company is correcting distributor inventory in general trade to have temporary decline in top line. They come out and say that lower primary sales will impact profitability, and they see single-digit decline in consolidated revenue. They expect operating margin to decline in mid to high teen levels as well. In fact, MK on Dabur has gone ahead and downgraded it to an add from a buy. They've cut the target price as well from 750 to 650. That's still an upside to where the stock is in any case, but their target price has been cut down. According to MK, the Q2 inventory correction is a surprise, where Dabur has talked about its pipeline build-up, and they see an earnings cut of 8 to 11% in between FY25 and 27 estimated. Although the silver lining as far as Dabur is concerned is rural rebound and better winter sales will see some recovery. Marico is actually in line in their business updates, but relative to Dabur looking better, which is why I would say it's a thumbs up. It's all about timing and who you're standing next to. So the sector has witnessed stable demand trends with rural outperforming urban for a third quarter in a row. That's what Marico has said. Domestic business has posted mid-single-digit volume growth. Foods and digital-first brands have sustained strong momentum. Nuvama is fairly bullish as well. They've retained a buy on Marico with a target price of 780. And they say after a weak update from Dabur, Marico's update reassured investors. Consolidated revenue growth is likely to be 8%, and domestic business should clock 5% volume growth as well. So these two. And just an Aurobindo Pharma I would look at because of some news coming in, and that's a thumbs up for them. They've received a US FDA approval for cephalexin tablets. I hope I'm saying that correctly. This is used to treat infections caused by microorganisms, and they're eligible for 180 days of shared generic drug exclusivity. The launch is by Q3 of FY25, so that could be a bit of an upside for pharma. I would say for Oro Pharma, I would say in any case, Agam, on a down day like today, pharma and FMCG could be a safe haven in relative terms.
Yeah, certainly. And we've seen mixed trends there. But of course, the other sector which will be in focus is the auto sector. And we've had more numbers come through. I'm going to talk about Hero MotoCorp. It's actually not been a bad month for Hero MotoCorp, despite what the recent brokerages have been saying. And we're looking at a 21% growth on a year-on-year basis, even though scooters have seen a little bit of a decline. All in all, its motorcycles have, started to see some traction there. But Maruti Suzuki, on the other hand, is looking at a 2% decline on a year-on-year basis, where domestic sales, in fact, have taken a hit of around 1.2% year-on-year, and exports, on the other hand, trying to play a little bit of a catch-up. That's where we've seen about 23% rise. It's going to be a neutral one for Maruti Suzuki, to be honest, because we must remember that September as a month is one which is seasonally not the best, because there's a lot of inventory build-up before, of course, we see the start of the festive season come through. And we're going to finally talk about CSB Bank. Well, the numbers look good for CSB Bank, at least as far as its deposits and advances are concerned. Strong 25% growth on a year-on-year basis for its total deposits. And, well, gross advances looking at a gain of around 20% year-on-year as well. CNBC has also been one of those counters which has actually seen a significant improvement in its performance of late over the past few quarters. And it does seem like it's going to have yet another quarter, but we're going to have to keep an eye on the provisioning as well as its asset quality. But other than that, numbers looking quite good.
Okay, so those are some of the stocks on radar, but a lot more. I think let's talk about metals as well. Metals has been one bright spark through the last few trading sessions, thanks to China's aggressive moves to prop up their economy. In fact, Nomura has come out with a note talking about this. Mihika, what is topping Nomura's favorite list?
Yeah, good morning, Tamanna. So the key two stocks that they've actually initiated coverage on is JSW Steel and Jindal Steel and Power. Let me start with why they've initiated coverage. Now, they believe that Indian steel producers are currently at a sweet spot, and there are structural reasons for the companies to demand higher valuations based, compared to historical levels. They've highlighted factors like higher return on equity, higher domestic demand. They've also stated that the global liquidity cycle is turning favorable for the metal sectors, and that these steel companies could see lower cost of equity going forward because of their continued deleveraging efforts, and they believe that Indian steel companies are better placed globally. And they have also stated cost drivers, especially the lower coking coal prices, which is a key raw material in the steel making process, could offset the impact for lower realizations because steel prices have been on a downtick. Now coming to JSW Steel, they've initiated coverage with a buy rating at a target price of 1,220, which implies a 22% upside for the company. Whereas and they believe that the company will benefit from upcoming capacity, the raw material backward integration efforts, and they also stated that JSW Steel is better placed when you compare to the other integrated steel players in the market. And then for Jindal Steel and Power, they've initiated coverage with a buy rating at a target price of 1,200, which implies a 17% upside to the previous close. And the positive outlook is based on similar factors, which is upcoming capacity expansion and the possible cost reduction that the company could see because of its various efforts that they are doing to reduce their costs, which would help expand their operating margins.
All right, thank you for that, Mehika. So metals in focus. I think you will have a whole host of stocks that are going to be in focus today. Metals for one, definitely. IT saw a massive resurgence in trade on the 1st of October. Does IT stay up or not? All of that after a very short break. But we're coming back with your F&O strategy for the day. After this break, stay tuned for that and more.
Welcome back to India Market Open. Well, we are taking a look at how things have fared last Tuesday on the futures and options space. And given the kind of expected volatility in the start of the day today, what can we expect today going in? Now, it was a day of trade where, while it was a volatile day of trade, we didn't see too much eventually as far as your benchmarks are concerned. The Nifty closing largely flattish, and we saw a little bit of unwinding in open interest. But today, we're watching out for 25,600, 25,500, given the kind of expected, weakness in earlier on in the session today. And that's something that we will have to bear in mind. But moving on, as far as the Bank Nifty goes, again, we lost out on the mark of 53,000. And we also saw shorts into the system at the moment. So it does seem like, all those who did, in fact, go ahead and sell futures could potentially see a bout of profits coming through, at least earlier on in the session. Moving on, coming down to the options market, pardon me, sure enough, we've seen a lot of writing around 26,000 call and all those call levels above that. But it does seem like that traction will shift lower. And as you notice, there's been very little open interest building around 25,500, 25,600. So those are the two levels that we're going to watch out for on the lower end of things. Pardon me. And finally, coming down to stocks, we have Atul, Granules, as well as IGL, along with GNFC, which are looking at longs. And among stocks which are unwinding, Balrampur Chini, Hindustan Copper, and Petronet LNG, looking at about short covering. But the question really is that what do you do with these markets? So we have Milan Vaishnav of Gemstone Equity who's joining us on the show right now. Milan, good morning. Thank you for joining in. Milan, I know that we're going to potentially see a gap down in the markets. And because of that, I'd reckon that you just want to wait and watch before you, in fact, go ahead and deploy an option strategy on the indices. But what are you making of these markets right now? And based on the kind of levels that we see in the open come through, what would you tentatively do with the benchmarks?
Well, good morning, Agam, to you and all the viewers. Today, we are looking at more than one thing, so to say, because first of all, obviously the Nifty is weak. We are going to see it opening lower, but I expect it to open near the pattern support levels, which are around 450 to 500 odd levels. That's where I expect the Nifty to find some support, and we might see some improvement as we go ahead in the session. That is one thing. Second thing, of course, we have geopolitical tensions in the Middle East to deal with, but sentimentally, even SEBI coming out with the change in F&O norms ahead of the market holiday is also something that would be weighing on the sentiment. On the personal note, I'm a little surprised why SEBI had to speak ahead of the market holiday and instill some kind of fear and panic. But okay, that's not something that we can do anything about. But right now, I would suggest that one should wait and watch and see if Nifty is finding support at around 25,500. That is one point. Another thing, if we look at the charts completely in isolation and not take any other external factor into consideration, we had deviated quite a bit from our mean, because even the 50-week moving average was around 9 to 11% lower than the Nifty level just a couple of days ago. So some mean reversion cannot be ruled out, and there is something which is taking place. And on the top of it, we have some external events like SEBI speak, so to say, and this geopolitical tension. They are all going to weigh heavy on the markets. So I am of the opinion that we should not be taking any compulsive trade in the index options. We should wait and watch and see if Nifty is finding support at the pattern support levels and it's stabilizing there, or we are seeing some incremental weakness coming into the markets.
Okay. That's as far as benchmarks go. Milan, what about IOC? I believe you have an option spread out there.
Yes, IOC is building up great underlying relative strength, and it's staring at a multi-month breakout. Some stability in the crude prices is likely to help. Even a day before, when the markets were weak, we had seen this stock staying extremely resilient to the market weakness. So I'm looking at IOC. I'm looking at initiating a bull call spread. I recommend buying IOC October 180 call and selling 195 call. The net premium that we'll pay would be around 4.35 rupees. The maximum profit we are eyeing is around 51,900, and maximum loss that can happen with this trade is 21,200. So there is a decent risk to reward ratio of 1:2.5, and we will recommend taking profits if IOC moves past 195, and as a protective stop, I would suggest exiting this call if IOC slips below 170 here.
Okay, Milan, I just want a follow-up question on the potential changes that will come through. Of course, come 20th November, we will see your weekly options expiries come down to 2, 1 per exchange, as against 6 or 7 actively traded weekly options expiries right now. Do you think you could make a conjecture on how trade could potentially change in option markets going forward?
Yes, I do. First of all, I see that the step that has been suggested by SEBI is I will call it detrimental to the interest of the retail investors. I see a lot of volume shake-up coming out, a lot of retail people, they are getting thrown out of the market. Because if we are talking about improving the risk profile, that could have been done by decreasing the lot size rather than increasing the margins and the contract size. So there is a lot of checkout that going to happen. We will see a lot of volatility, lot of adjustments going on, and maybe I don't know which contract will get will get to settle weekly, but it's going to be a very unsettling environment at least until November 20.
All right. Well, we'll be watching out for a lot of the impact which comes through on the November 20th. But Milan, on that note, thank you for joining us and taking us through your views on the markets. With that, it's back to you, Tamanna.
Thank you for that, Milan. And I found it interesting, Agam, that Milan talking about why the announcement was made on a market holiday. And it's given some room for panic as far as investors are concerned. But another big story and the take on it, RBI's MPC has got new external members now ahead of the key rate panel meet scheduled for October 9th. And remember, we told you first, our very own Shrimi Chaudhary broke the story that external members have been identified and will be coming in. Harsh is joining us with the view coming in from houses on who those external members are. Yes, Harsh.
Well, first off, Tamanna, just with regard to how big this is, because two of the external members in the previous policy voted for a rate cut, and this is going to be the first meeting after the Fed has cut rates and therefore holds key as to how India responds or how the RBI and the MPC respond in terms of their position to that Fed rate cut. Three new members, of course, coming in. First off, we have Dr. Ram Singh. He's director of the Delhi School of Economics, PhD from JNU and postdoctorate from Harvard. He has expertise in contract theory, public-private partnerships, law and economics, and he's advocated in the past for balanced fiscal policies, equitable taxation. Tax cuts have been opposed by him, and he's also opposed farm loan waivers. That's one of the three members who's going to be joining. The second one is Mr. Saugata Bhattacharya. He is, of course, a financial sector veteran, economist with over 30 years of experience and was chief economist at Axis Bank. He's participated in key government committees and he specializes in infra finance, policy advocacy, as well as consumer behavior analytics. The third member who's coming in is Dr. Nagesh Kumar. He is director and CEO of the Institute of Studies for Industrial Development, and that post is something he's held since May of 2021 with extensive experience in international development, previously held and served as including on many committees as well as boards, including the board of Exim Bank, as well as other global institutions. What one can expect of is the stance likely to remain. However, a possible change in stance, while the rate's likely to remain, possible change in stance is something that Nirmal Bang is looking at in this particular policy. Nomura has a slightly conflicting view against the consensus. They believe a 25 basis point rate cut could well be on the table this time around. And they also believe that over the course of the next few committee meets, there could be over almost 100 basis points of rate cuts pretty much through the cycle. So, of course, a lot of these questions will get answered come the middle of October. But, of course, the relevance of these changes definitely something that the street will be looking out for.
Yeah, definitely. Thank you so much for that, Harsh. And we'll hear in the next lot of minutes of the MPC meet on what these new members think. And of course, congratulations to all of those new members. Let's take a look at what's on NDTV Profits watch list this morning in terms of good news. And today is a day when the market's definitely looking for some good news. Stock specific wise, Paras Defense, the QIP opens floor price of 1,096. Why are we saying it's good news? Because in this market right now, a fundraise is being seen as a positive. Let's see if that continues for Paras today. Ashoka Buildcon has an order win of 1,264 crore rupees from MMRDA. Hero has strong growth numbers. Their numbers for the last month were decent, 19% up year on year. Nomura has been constructive on JSW Steel and JSPL in view of what's happening with metals. And Jubilant is the other one we're looking at, Jubilant Ingriv, as subsidiary partners with major agrochem company for agro-intermediate. So that is definitely positive.
Also watching Marico, where the numbers are in line with street estimates. Do remember, these are just pre-quarter expectations, but we get plenty out there. Bharat Forge, of course, will have an AM meeting on the Mandus Pact, so that's going to be in focus as well. On the other hand, names like BSC along with discount brokers like Angel One and IIFL Securities will be under pressure on account of change in F&O regulations coming in from SEBI and Dabur. It's been a soft quarter and below expectations with respect to its top line, and as well as the moderation in operating margins. That's something that could potentially weigh on this particular FMCG major as well.
All right, let's take our first calls. Neerav Asher is joining in, Head of Equity Research Analyst at Latin Manharlal Securities. Shrikant Chauhan, Executive Vice President and Head of Equity Research at Kotak Securities, with us this morning. Very good morning to both of you. Thank you so much for speaking with us. Shrikant, were you surprised with what you heard from SEBI, and what is the impact you're seeing on indices? Let's start from there.
Yeah, good morning, Tamanna. Good morning, everyone. I think, it was more or less expected that the outcome can be like this. And maybe on that, it will take first few weeks, there will be some adjustment. But eventually, I think the market will digest to the same. And again, the traders will start participating accordingly. So broadly, we are of the view that I think market is going to follow the global macros and major trends. These are the things which are actually something which will help them to design their strategy in a fresh way.
Shrikant, I'm just looking at some regular technical parameters, your exponential moving average, that's a 20-day one, that's somewhere around 25,600. We also have a lot of put writing around 25,500. Based on these parameters, considering we're expecting to see a weak opening, what do you think, and where do you think the market could potentially take support at?
Yeah, I think the way the market is correcting from the highs without any pullback, it is just breaching important levels. Based on the technical parameters, and as you mentioned that averages, yes, we give more weightage to the simple moving average, 20-day simple moving average, which is around 25,500 levels. There the market is having excellent support. Also, if we consider the retracements, then based on that also the markets will be now very close to the 50% retracement of the entire rally, which we saw from the lows of almost 25,000 on the downside. So broadly, I am of the view that whenever we see the market is dropping to 20-day simple moving average, we see some rebound, and that rebound actually again pull the markets to the some decent levels, like maybe 25,800, where the market has spent time in last 2 days. So after hitting the levels of 25,500, again we are expecting rebound. So close to 25,500 or below that, we should look for taking some contra bets in the market. Accordingly, if we go through with the Bank Nifty, then there also, after hitting the levels of 52,500 or 400, Bank Nifty will be also very close to the 20-day simple moving average. Broadly, I am of the view that these are the levels where I think we can see some rebound. And I think already Gift Nifty is indicating some 250-200 points lower sort of opening for us. So close to these levels, certainly we should look for taking some contra bets in the market. But yes, in case if we see the market is dropping below 25,300, then we could see further more weakness. And for Bank Nifty below 52,000. So these are the important levels. And today it's a weekly expiry day. So I think based on levels, we can design our trading strategy.
Okay, so it's a weekly expiry day. You need to be nimble. 25,000. If you're dropping below those kind of levels on the Nifty, 25,300, 25,500 onwards, you can take a contra bet. 25,300 and below, we're in for a bout of trouble. That's what Shrikant is saying. Let's get your picks in, Shrikant.
Yeah, see, commodities are really doing well. And if we go through with Hang Seng and Shanghai Index, then based on their technical parameters, I am of the view that they are going to do well for next several weeks. I think accordingly, like we have to take strategy in this market because already we are opening lower. We should look for adding those stocks which are like very strong in terms of momentum. And again, we can see some rebound if there is a rebound in the market. NALCO, National Aluminium, which was around some 223, 225 levels on Tuesday. If we see that stock is opening somewhere close to 220 or maybe 218, then there we should look for taking some long bets with a stop loss at 207. I'm expecting stock to move towards 235 and 250 in next few days. So it's a very decent candidate to buy if there is any correction. Also, we like ONGC. The reason is because it was like consolidating when the crude was falling. And now when the crude is again jumping back from the lows, and there is a now talk that it may again move towards the levels of $80, then in that case, ONGC looks good. Keep a stop loss at 280 for creating any long positions. On the high side, 305 and 315, these are the two levels to watch out for.
Okay. Those are the levels to keep an eye on when it comes to the Nifty, but and of course, pardon me, the stocks that what Srikanth has suggested to us. But Neerav, welcome to the show. Your view on some of the brokerages now, the listed broking companies now, given the kind of regulations that we are seeing of the SEBI, with the SEBI come through, what's the way forward?
Yeah, good morning and thank you for having me on your show. Definitely, I think as it has been pointed out that to some extent this was expected, but definitely it's going to have a negative impact as far as the brokerage houses and the exchanges are concerned, especially the increase in the ticket size from 5 lakhs to 1.5 million. And the reduction in the option expiry per exchange per week. So that these two factors are going to be very, very important, and they are going to have a detrimental effect on the brokerages as well as the exchanges.
Okay, well, let's also talk a little bit more about the FMCG space, because we actually do have updates from Dabur and Marico, but I'm going to just put the spotlight on Dabur. We have Mahima who's joining us to give us, and firstly, the update, but also what brokerages are making of this latest update. Mahima, over to you.
Right, so Dabur is expected to have operating margins to decline in mid to high teens level as per the Q2 business update, and they expect revenue growth to revive from October 24. They're seeing mid-single digit decline in the consolidated revenue overall. Now, heavy rains and floods across India has impacted consumer offtake in Q2, and beverage category saw some impact due to heavy rains. And what the management has said that higher growth in organized channel of e-commerce and quick commerce is leading to higher growth in modern trade, and this has led to higher inventory levels. So this is a major concern when it comes to Dabur. Now, a couple of brokerages have come out with their ratings and views on Q2 business update of Dabur. MK has downgraded Dabur to add from buy with a target price cut from 750 to 650. Now they are seeing earnings cut of 8 to 11% over FY25 to 27 estimates, and they remain hopeful of business recovery on the back of rural rebound and better winter sales. Now City on Dabur has again maintained sales and reduced target price to 570, and this is a downside of roughly 8%. What they believe is that quantum of impact of inventory pileup will be as high as 10% in Q2 growth, and they've cut 25 to 27 estimates by 3 to 6%, and they forecast 5% consolidated revenue decline, 17% EBITDA decline, and 19% PAT decline. Nuvama on Dabur, however, has a contradictory view. They've maintained buy with a target price of 760, which is an upside of 23% from its Tuesday's closing price. And what they're saying is that EBITDA is likely to clock a 15% decline. However, Q3 shall be slightly better than Q2, and they expect consolidated revenue and EBITDA to fall 5% and 15% respectively. And they expect overall EBITDA margin to fall to around 18.5%. Now, in terms of what Jefferies is saying about the note, well, it's a very interesting note. The note suggests that though Dabur has posted a muted Q2, it may not be the same for all the staple companies. Majorly on the back of higher inventory levels, Dabur has posted muted growth. In terms of industry trends, what they're saying is that demand will continue to be moderate, and there has been no persistible pick from Q1, and rural continues to stay weak is something which is worthy of highlighting in the Jefferies note. And what they're saying is that the new age wage impact overall has been very mixed when it comes to the staple companies, and overall the margin impact on Dabur could see some pain in Q2 as well as Q3. Now lastly, what they're saying is that concerns have been high in terms of Honasa's inventory level also, and what they're saying is that there could be some possible correction, in some cases bottoming up in stock, which has which will have more impact in their view. So this is the overall view of the entire consumer sector, of course, but Dabur, yes, will see some kind of pain in trade today on the back of weak Q2 business update.
Thank you so much for getting us that update on Dabur. I'm going to very quickly go through Marico as well. And here, quite to the contrary, we're actually looking at some positive trends. So firstly, the company says that they're expecting double-digit revenue growth on a consolidated basis for the second half of this financial year. They're expecting gross margins that could see a little bit of a moderation on a year-on-year basis, but double-digit always bodes well. Do remember there's been a lot of commentary with respect to rural growth over the past couple of quarters from all the FMCG players, and it does seem like even for this particular quarter, rural growth has outperformed urban growth, and that of course always bodes well with respect to demand on an overall basis. Moreover, Marico also says that foods and digital first brands have sustained growth momentum, and going forward the company is expecting to deliver double-digit revenue growth on an overall basis for the entire year as well. Based on that, we have Nuvama, who retains a buy with a price target of around 780, and they also do suggest that international business, which is likely to drive growth going forward, looking at around 13% growth, as well as revenue growth, overall revenue growth with about EBITDA growth at around 5%, could potentially bode well for the company. But looking well for Marico specifically, and considering we are looking at double-digit growth for the entire financial year, Tamanna.
Absolutely. All right, Nirav Asher also with us. Nirav, just getting your take on what is the kind of impact we will see on some of the discount brokers, capital market players, and as well as a BSE today after SEBI's regulation. What does this essentially do? Does it drive money now away from derivatives to maybe the cash market, or do people sit it out? How long do you expect the concerns we will see today, this morning, to continue?
The initial impression is that this step is likely to break the back of the smaller investors, the fringe investors, or the younger lot, basically, who have been trying their luck in the markets. So in a way, from a long-term perspective, of course, this will have positive implications in the sense that it curbs volatility and speculative nature in the market. But I think from a brokerage house perspective, or as well as the exchange perspective, it's definitely going to be it's going to be damaging, definitely.
Nirav, in terms of how you are seeing FMCG stocks today, we talked about Dabur, we talked about Marico. Are you seeing a bit of a drubbing going out there, looking at what the Q2 business updates are like?
Well, it's been a mixed picture. I think Dabur has disappointed and Marico has given a very positive picture. But overall, I think the corporate India is waiting for the next 32 days, which is the start of the festival season from today. And that is going to be a deciding factor. That is one. The second important factor is that rural has made a very smart recovery and continues to outpace urban for the third quarter in a row. The input costs have been quite stable. From an FMCG company's perspective, we've been seeing positive commentary with respect to the international business. The international businesses have been doing quite well. The direct-to-consumer businesses, D2C, have been doing reasonably well, but the internet brands have been doing far better. So there have been pockets of excellence, and we've seen FMCG companies invest in advertising and sales promotion, building up brand awareness, etc., strengthening their distribution muscle. And even in the case of Dabur, what they have said is that their margins are going to come under pressure because they've been rationalizing the inventory at the distributor level. This will only improve the health of the distributors in the medium to long term. And a lot of money is being plowed back into the business, into advertising and sales promotion. So I think the overall perspective as far as the FMCG sector is quite positive.
Okay, well, there you have it. That's the view coming in on the FMCG sector. But on that note, we slip into a short break. And on the other side, we give you all the updates from the pre-open. Stay tuned in. Back in just a bit.
right, just a few seconds to go for the pre-open session. We'll wait for the rates to settle. Remember, you'll see maybe some dramatic numbers, right, in the first couple of seconds. But nevertheless, you might have a tough start to the morning, a tough start. And this is something which probably the regulator would be expecting. F&O has seen a huge curb coming in. Many of these in line with the proposals that SEBI had put out. What is going to be the impact is what we're talking about this morning. Ashish Rathi joining us. He's whole-time director at HDFC Securities. Mr. Rathi, very good morning and thank you for speaking with us this morning at NDTV Profit. Let's just talk a bit about what SEBI has done. Now, one view is that people who are now habituated to derivatives trade will find a way. They will find one way or the other. Do you think that that's what's going to happen? What is the kind of impact you're seeing on volumes?
So what will happen typically, I mean, if you look at the SEBI circular which has come, you are absolutely right. I think so what was there as a discussion paper has actually come out in the open. One thing they have removed out of 7 recommendations, 6 have come. But in terms of volumes, we will have to wait and see because it is getting staggered. So the major impacting volume items are scheduled to go live since November 20, which is probably the one of the most biggest item is this weekly expiry. Now, what is currently allowed is 5 weekly expiries. Now, what happens typically is with the new circular in place, you will have only 2 weekly expiries. So probably some kind of rationalization in terms of volume should happen because if you look at the major volume in options, particularly index options was happening through these weekly expiries. So we expect some kind of rationalization of volumes definitely to happen because of this move of SEBI.
Extent is the question. I mean, what we are learning is you'll see 40 to 50% of volumes sort of rationalized, as you put it, because of expiries. In terms of impact for exchanges, let's start with that. One listed player, BSE. Let's see what BSE is also doing pre-open. In terms of impact for exchanges, do you think that this is a huge hit, Mr. Rathi? And for brokerages, for the discount brokers, what is the impact for the community?
So typically what will happen is now brokerages also are divided into two lots, one which have high dependency on derivatives volumes, one which have lower dependency on derivative volumes. Okay. So the one which are having higher dependency on derivatives volume and their income probably depends on derivative will be highly impacted. Probably the street estimates could be 20%, someone is saying 15%, but we'll have to actually see it. But wherever the dependency on derivatives volume or equity derivatives volume is high, probably the hit would be much higher, and probably where the derivatives, where the dependency on derivative volume is less, I think so the hit will be much lesser. We will have to see how it pans out, because November 20, post November 20, you will be able to feel how it works out, because some regulations will come obviously after Feb 1, 2025, and some are scheduled for April 1, 2025 also. So brokerages definitely where dependency on derivatives volume is high will see a hit in terms of volumes, and obviously that affects your bottom line. And in terms of exchanges, what happens typically as of now, if you look at weekly expiries, so probably there are 5 weekdays, out of which in terms of weekly expiries, NSE has 3 days and BSE probably has 2 days. So obviously if you go by that ratio, one of the exchanges might have a comparative larger impact. But overall, we'll have to see if people then pounce onto that only 2 expiries in weekly and compensate for volumes which were spread across 5 expiries. We don't know. We'll have to see it. Post November 20, most of the things will get cleared.
I want to talk specifically about the sophisticated pocket in the F&O segment. There were a lot of algo trades and a lot of systems based on weekly options expiries. And I'm not talking about the recently introduced ones. We've had Bank Nifty, which has been around for years now, more than a few years now. And besides that, we've also had a lot of these sophisticated traders who actually trade in relatively larger sums, who will have to give up on Bank Nifty. In fact, on X, we have a very long list of influencers who suggest that it would be a pity if the Bank Nifty moves out of the weekly options expiry going in. What is your conjecture? What is your guess as to how trade could potentially change come November 20th when you in fact do see the new norms come into play?
See, what will happen is post November 20, so we will have in a week only 2 expiries. One obviously would be of BSE and one obviously would be of NSE. So all these algos which were concentrating on across, Bank Nifty might go out and you will have only Nifty. They will re-strategize to have Nifty. That is what they can do at best as of now, since the product itself is not available. Secondly, the monthly expiries still continue. Okay, so there is no restriction on monthly expiry. And some of the volumes, obviously, you will see it shift to monthly volumes rather than on this Bank Nifty weekly volumes. So that is what can happen. And what happens typically, see, on indexes, why there is such a large volume, I'll tell you 2 probable things is there. One is these indexes are very liquid. That is one reason. Second is what happens, indexes it doesn't result into physical delivery of any instrument. While in case of stock futures and options, yes, it results into physical delivery. So that question doesn't arise in index. So these are the 2 things which actually makes index probably more liquid to trade and people want to trade into it.
Okay, well, we leave it at that. Thank you so much for joining us and taking us through your views on the latest with respect to changes in the F&O norms that have been brought forward by the SEBI. But let me take up the question of auto sales with Nirav as well and what he's making of the month of September. Nirav, we've seen mixed numbers coming in, but I'd reckon to a certain extent there is always and seasonally a little bit of a build-up in inventory before we start seeing the sales will run up significantly as we move into festive season. What is your take and assessment here?
Well, as you rightly pointed out, it's been a mixed picture as far as the auto sales are concerned. But I think the winners are the two-wheeler segment And we starting off with Bajaj Auto, which has reported very strong domestic two-wheeler sales, and there has been an improvement in exports also. We've seen Hero MotoCorp, which has posted very strong set of numbers. Escorts, Eicher Motors, especially in the 350cc plus category, has reported strong set of numbers. International sales have done quite well. And TVS Motor Company maintains its healthy and consistent show. So I think two-wheelers have done quite well. As far as the commercial vehicles are concerned, I think we've seen some faltering as far as Tata Motors is concerned. I think both Tata Motors and Maruti to some extent have disappointed the market. But I think the winner is, of course, Mahindra & Mahindra, which has posted very good set of numbers on the utility vehicle space, SUV space. So I think this is the broad sectoral take. But I think there are smaller players like SML, Isuzu, Force Motors, which continue to do very well. There's been an improvement in the performance of smaller players like Atul Auto too.
Okay, the pre-open rates are not looking pretty. They have settled, but you're clearly going to be seeing a bit of a cut on the Nifty as we open 340 points down on the pre-open session. So prepare, brace yourself for impact. Clearly what's happening on crude front is impacting markets, and you're seeing that quite dramatically. Good day for ONGC and Oil India. Remember, Shrikant Chauhan had called out ONGC as his stock of the day, or his stock pick. BPCL doing badly. HPCL, IOC, all your downstream players as expected are getting fairly hit. Autos is finding it tough. Asian Paints, of course, crude impact. Bajaj Auto, Tata Motors is flailing, at least in the pre-open session, and M&M as well. So you have this mix of it's a tough morning. It's going to be a tough morning, there's no doubt about it, and in part because of SEBI's action. In fact, Harsh is joining us for the brokerage report of the morning, and Jeffries has a very clear indication on India brokers. In fact, Jeffries doesn't seem too alarmed, Harsh, from the first reading. They're saying this was expected and the action is calibrated.
Absolutely, Tamanna. In fact, what they're seemingly suggesting is a lot of this is already built in. They are saying that they're already built in a 10% EPS cut on the back of everything that's just happened. In terms of regulation, it's broadly in line. In fact, what they are also saying is that it's going to be a phased implementation, and therefore the knock is going to be more calibrated. The tightening is going to be more calibrated, which is likely a positive to a certain extent. Well, lot size and margin hike, they believe, is lower than anticipated, which has been lower than anticipated, at least as per the draft, and that also is something they see as a positive. Now they believe that the focus shifts to participant behavior post the implementation, so that is something they're really looking out for. They believe discount brokers, Angel One already seeing a knock, 5 Paisa already seeing a knock, can be most impacted, followed likely by exchanges. So we'll wait and watch as to how BSE opens this morning, but that's one thing that will be on pretty much many investors' radar. AMC's wealth managers, depositories, they believe will remain unaffected.
Okay, so depositories will remain unaffected, but your discount brokers are going to be hit, and that's what you're seeing. So wealth managers, so Nuvama not too bad, CDSL still 1.5% down, BSE, I want to see where BSE is finally settled in the pre-open session. Motilal Oswal about 2% down, BSE also 1.5%. So all of these are going to be clearly hit. Shrikant, but I just want to understand if you are seeing any opportunities here, and let's talk a bit about the blue chips today. We talked about autos, and you had some auto numbers coming in over yesterday as well, at least the big ones. Maruti post-market close, Hero post-market close. Any of these that you would say give an opportunity, or you'd stay away for now?
I think, after opening to the lower levels, again, we need to focus on stocks where there is overall momentum trend as well as the specific positive news flow. I think in that case, Mahindra & Mahindra looks really good, which is around some 3100 levels, 3150, 3100 levels. In case if we see the stock is dropping to, let's say, 3100 or maybe 3050, then there we should look for taking some long bets. But yes, I'm of the view that Mahindra & Mahindra is heading for the levels of 3,500 eventually. It will take some time, but yes, it is heading higher. For Hero Motors, we could see some short covering, but again, it depends. Like we are not going to see any major trending sort of rally because the stock has corrected sharply from the highs. But yes, because the unexpected this thing, what I can say, the way they have reported the numbers, the street was not expecting these numbers, and maybe because of that, we could see some rally in the stock. But I think from the auto space, Mahindra & Mahindra and Tata Motors should be on the watch list.
Sorry, if you can just come in on Reliance Industries, because that's been one of your heavier weight companies which has seen a lot of weakness over the past 2 days. It does seem like it's going to take another big knock, and I know that 2% may not seem much, but it's Reliance Industries. And I'm looking at support levels, or rather the lows in the recent few months, and it does seem like Reliance is going to test that today. What's the way forward? What is your assessment here?
Yeah, on immediate basis, the stock is having support of 200 days simple moving average, which is around 2,900 levels. And in the past, if we see the chart of last, let's say, 6-7 months, then whenever the stock has fallen to 2850, 2860 sort of levels, from there we saw a rebound. I think these are the levels, I think, where the stock should stabilize. That's the view on the stock. And again, if we go through with the geopolitical tensions and the way FIs are selling in the market, I think these stocks, I mean to say HDFC Bank, Reliance, all these heavyweights are going to remain under pressure. But at the same time, we cannot forget that our broader trend of the market is still bullish, and there is like hardly any major impact. So I am of the view that if we see these stocks are available at important support levels like 2850, then there we should look for taking some contra bets of going long.
One quick top call after we've seen the pre-open rates settle. Is there anything you'd go in on today? And yes, ONGC, which you called out, is doing fairly well in relative terms.
Yeah, I think absolutely. This ONGC and Nalco, these are the two stocks to buy for, because ONGC is like already into all-time, I'm to say it is into long-term breakout and it is correcting from the highs. But I'm of the view that these are the levels where we should look for taking some long bets on ONGC, and for Nalco also, because there also I am expecting there are like fundamental triggers, and if the stock is correcting back to its important support levels, I think the buying should emerge in the stock. So these are the two stocks on which I'm going to focus today.
Okay. It's 20 seconds left to open, and it's going to be a tough morning. Think of all of the factors today. Iran, Israel, war escalating, FII flows running to China at the cost of emerging markets like India, SEBI coming in and tightening rules on F&O trade as well. It's a day when the bulls really have to, charge up to come back on top, because the first trends are definitely bearish. Okay, this is the cut that was expected. 25,500 levels is what you need to watch out for. Are those going to be breached, and can we really hold up is the question. There seems to be some strength coming in the first few minutes, is at least the Nifty about 200 points down. The bank Nifty seeing a 1% cut, again, something that was expected. Let me quickly go to the heat map and see whether there's any green in what is possibly a sea of red. Yes, there is at least some green coming in. I'll start with the reds first. So high crude prices is always a concern. BPCL reflecting that. High crude prices on one hand also hitting in Asian Paints, but look at the whole list of auto companies. The numbers have been below par. In most terms, Eicher, Bajaj Auto, Tata Motors, maybe some outliers here and there, but definitely autos under pressure, M&M as well. Add to this other indicators, all right? September sales have been soft. GST collections have been the lowest in 40 months for the last for September, so that's also hurting. Hero, better numbers than expected, but still down. HUL also feeling the pinch over there. On the upside, what's positive? JSW Steel, brokerage notes looking positive on metals, and have marked out JSW Steel, Tata Steel as well if you're playing the China rebound story, and ONGC, of course. Top pick of Shrikant Chauhan on NDTV profit this morning, doing fine. So a clutch of metal stocks, one Ultratech Cement managing to be in the green, but the rest completely red. This is going to be a tough morning maybe. Eicher now deepening to 3.5% cut on the numbers. On the broader markets as well, I don't think too much of a reprieve On the other side, broader markets even worse hit, Agam.
Big surprise, Tamanna. BSE opens in the green. It is in fact in the green right now. So that's the very interesting thing. Now that's led me to believe, or rather understand, is this an opportunity for the BSE to gain traction in its options market? Given the fact that we are looking at that uptick. It's not a huge uptick, but in a market which is down at 1%, BSE is up by nearly 1%. So that's a surprising one. Let's take a quick look at the broader market indices. Sure enough, they're moving largely in tandem with the Nifty 50. They're falling. So both the mid-cap and the small-cap indices are taking a knock. The mid-cap index is down 1%, 1.25% decline for the small-cap index too. And with that, we'll take a look at those stocks which are in fact in focus on account of changes in F&O norms brought forward by the SEBI. So we are taking stock of the BSE, we're taking stock of something like an Angel One, or for that matter, the IFS Securities. And you know what? So that's clearly not the one that we want to keep an eye on. 20 microns is not the one that we wanted to address. We wanted to address Angel One. Yes, there you have it. So 3% decline there. IFS Securities also looking at a 3% decline. BSE, on the other hand, is up 1.5%. So there not only is there no selling, there's in fact quite a bit of buying coming through for BSE. Moving on, let's talk about the other factors which are in focus today, the other stocks that are in focus today. Dabur taking a knock of 6% on the back of that quarterly update coming through. Marico again on expected lines, moving up by around 2%. Double-digit growth always bodes well for FMCG companies. And with that, we also have quarterly updates from relatively smaller banks. So CSB Bank, well, largely flattish. And as far as the other banks concerned, the South Indian Bank, that's also looking at marginal gains coming through. But these two banks have seen a reasonably good quarter when it comes to advances as well as deposits. But all in all, well, broader markets perhaps on expected lines, but also the cuts are not as sharp as what we were working with, Tamanna, this morning.
I would say it's not a pretty picture, but definitely inherent strength of the Indian markets can be seen. Dabur, the big hit of the morning. Dabur India about 6% down as was expected. I'm going to pull up BSE once more, and what Agam has pointed out is absolutely correct, that BSE is now 4% up. Now the reason for this, Agam, if you just look at it logically, you were 4:1 or 3:2 compared to weekly expiries.
Now it's 1:1.
Now it's 1:1. So you have equal opportunity, level playing field.
Yes.
At least 50% potentially of whatever volumes are left come to you.
Yeah.
So you're on the same, because compared to NSE, the BSE volumes, NSE was gigantic.
Absolutely.
Yeah.
And it's not like BSE's BankX did have considerable volumes. Its Sensex did. And this only means that the Sensex weekly options expiries will continue to see a lot more increased traction now that NSE stands to lose out on something like the Bank Nifty, assuming the Bank Nifty goes out.
Okay, so even if it's Bank Nifty versus the Sensex, you still have or Bank Nifty versus BankX. So whichever combination of those two, you have a level playing field now, essentially. 50-50 comes in. You're as much a player there as anyone else. Nirav Asher, Shrikant Chauhan, first calls. Let's talk about BSE first, Nirav. What is looking so exciting about the stock?
One, of course, is the scarcity premium, and now, of course, as you pointed out, that there seems to be a hidden opportunity. But I think that is something which only time will tell. So we have to wait and watch. But for the time being, BSE is having its time. It's having a good run at the moment.
MCX also doing okay. In for the ride, I suppose. Look at Marico. Marico about 4% up. Like I said, depends on who you're standing next to. So compared to a Dabur, I don't know if you can pull up a dual chart of Marico and Dabur. Both had their business updates out yesterday, and in comparison, Marico coming out smelling like roses, while Dabur was seen as a bit of a shocker. So Marico up at this point about 3.5% up. Shrikant, are you liking any of these FMCG plays, or you're staying away? And any view on BSE on the charts?
Yeah, I think from the FMCG space, Marico is doing fairly well. It is crossing all its important levels whenever there is a specific news flow or rally in the market, which clearly suggests that the stock is heading for at least 750 in the near term, and maybe in the long run, we could even see the levels of 825 based on its technical formation. For Dabur, I think now it is corrected back to its important support levels of 580, 85. I think if there is a medium to long-term view, then we should look for adding this stock also to the portfolio, because overall space is doing well and there is like defensive sort of strategies which are coming in the market. For BSE, I think it has been consolidating, and after hitting the important support levels, again, it is rebounding. So maybe this 3,500 and 4,200 is the range in which we are going to see the stock is like consolidating. But on the dismissal of 4,200, we could see further more rally in the stock. I think till then we need to follow these levels to take any specific trade.
Take a look at some of the discount brokers, 5 Paisa, IFL, Angel One. Let's see what's happening to them while BSE is doing perfectly fine. 5 Paisa in fact recovered from its lows. It was down nearly 7% at one point. Motilal Oswal is down. Nuvama also getting hit now. Angel also getting hit now, as I'm sure is IIFL. So you are going to see the brokerages and their volumes perhaps get squeezed, as we've been talking about. Nirav, let's talk about opportunities. Let's talk about opportunities for a rebound. You know, for the last several weeks, whenever we talk to anyone about any major stock or sector, they say wait for corrections, buy on dips. Is this now moved away from a buy on dip market, or is there a buy on dip potential out there? And if yes, where do you see it?
Well, we've seen the heavyweights have been under pressure consistently. We've seen Reliance, ICICI Bank, Axis and HDFC Bank prominently. They pulled down the markets. And I think at this point of time, what the market has not taken into account very seriously is the geopolitical tensions. The way the war has spread to different parts of Middle East. Although it is not impacting the oil supply at this point of time, but the speed at which the escalation is happening, and we should remember that this war is now going to complete 1 year. It started around October 7th last year. So I think it shows no signs of abating. So this could be one cause of concern. And I think the first signs of this stress are being visible in the heavyweights. So I think we need to be a bit cautious, but at the same time, the domestic cues have been quite strong. If we look at the e-commerce companies, the sales, what they have generated, auto companies have been fairly good. FMCG has been doing quite well. Realty is into fundraising. And metals, I think metals have been making a comeback. So I think the steel space is looking quite good. There we like particularly Jindal Steel and Power, JSW Steel and Tata Steel. So that's the take at this point of time.
Jindal Steel, you would still go for. Shrikant, would you pick any of the steel majors or the metal players right now? Those seem to be the only ones keeping their head above water.
Yeah, I think as we are bullish on the overall technical formation of Shanghai Index and Asian markets, I'm of the view that iron ore which will remain in limelight, and that will help steel companies to do well, especially those where there is capacity. So in that, Tata Steel, yes, it looks good. The formation is indicating us that it is heading for at least 175, but in the long run, we could even see the levels of maybe 190, 195. So Tata Steel, Steel Authority, both the stocks should be on the watch list. But yeah, I think if I have to choose any one, then Tata Steel looks really good. Jindal Steel and Power, yes, of course, we are going to see upside, but there is a problem of that. It's a very a core player of steel. So if there is a over and above rise in the iron ore prices, then it will increase some pressure on the stock. But yes, we are also bullish on the JSPL, and we are expecting stock to move towards 11.15 next maybe 12 months of time.
I want to talk about two counters from the capital goods space which are actually starting to show a lot of strength, a lot of promise, and that's Siemens and ABB India. It does seem like they've resumed that uptrend now over the past few days. Your assessment on both these counters?
Yeah, for Siemens, it is showing a lot of strength. It is heading higher, and it is, I think, reversing to its sell-off that we saw from the levels of almost 8,000. But close to 7,800, 7,700, the stock is having resistance. We cannot forget that. And now the stock has rallied from the levels of 6,500 to almost, we can say, 8,000. So I am of the view that close to 7,700 levels, 7,800 levels, traders should be very, very careful. For investors also, I think it is better if there is any correction, because all these stocks are trading with extremely expensive valuation. So it is better if there is any correction, look for adding them. But otherwise, I think it is better to focus more on some other spaces, maybe like from some metals.
What is the index call right now, Srikanth, now that you've had opening rates settle to some extent? 25,560. Nifty is sort of holding on. Bank Nifty above the 52,400 mark.
Yeah, Tamanna, I'm of the view in the morning that this 25,500 is going to act as support, because there the the index is having supports of averages as well as retracements, extensions. So I think the way it is rebounding from the lows, I think it is working, but we need some more some support from other large cap companies. So I'm of the view that yes, 25,450 should be the final stop loss on intraday basis for creating any long positions at these levels, because from here again the index can rebound to the levels of 25,800. That's the overall view that I can make out based on its technical formation. For Bank Nifty also, 52,500, 52,300 is the area of support, and if there is any rebound, then again 53,200 sort of levels we can see on the chart. We have to keep a stop loss somewhere close to 52,000.
Right. Nirav, a quick word on how you could potentially look at the upcoming festive season and play the consumption theme as we move into the next couple of months.
Yeah, as we pointed out, the next 32 days will be important as the festival demand tends to kick in. And initial cues have been quite positive. We've seen particularly e-commerce companies point out that the major portion of the traffic has been coming from tier 2 and tier 3 towns and cities. So this, I think, augurs very well for the demand. And particularly, we've seen a strong demand for mobiles, electronic products. We've seen demand for ethnic wear, for casual wear, footwear, etc. So I think demand seems to be picking up in a positive way, and the festival demand coupled with the marriage season, I think, should augur well for various players in the market, like Aditya Birla Fashion Retail or the likes of the Manyavars and all those players which are into the ethnic wear segment.
Okay. So, festive season, remember, it's the first day of Navratra. So, happy festivities to everyone celebrating. The color of the day is supposed to be yellow. Color of the markets today is red, unfortunately, and in part because of what's happening in Iran, Israel, and crude price impact. Mihika is joining us for this. Now, Mihika, the first sort of few minutes of trade is telling us very clearly that this is one of the big factors. Take us through what's happening and which are the most impacted companies.
Yeah. Good morning, Tamanna. So Nifty Oil and Gas down about 0.7%. Well, it's key to highlight ONGC, the top gain on the Nifty Oil and Gas. It's up 1.6% intraday as oil prices have risen 4% only since Monday. Now, higher oil prices are a positive for ONGC's realizations, especially since the company does not have any windfall taxes levied by the government in the month of September at least. Now, when you look at the Indian oil marketing companies, on the other hand, which is your IOCL, BPCL, HPCL, they're all seeing heavy cuts. HPCL is the top Nifty oil and gas loser today. It's down about 4.8% intraday. BPCL and IOCL also seeing cuts of over 3.5%. BPCL saw an intraday loss of 3.9%. Now, higher oil prices are negative for the oil marketing companies because it does contract their marketing margins. Now, over September, we had brokerages saying that the companies have been experiencing supernormal marketing margins in the range of 10 to 13 rupees per litre on petrol and diesel, and the rise in oil prices and the risk that now pertain with the escalation of the Iran-Israel conflict could impact their marketing margins for the month of October. So that's the recap of the Nifty Oil and Gas and all the highlighted companies today.
Add Asian Paints to that list, and of course paint companies will be suffering as a result, and you pull up any of those counters because your input prices do go up. So paint companies in focus as well. Srikanth, ONGC, you've already said that you're excited about. What about in Oil India? Would you see some potential on any of the downstream names?
I think, let the market stabilize at these levels, because At these levels, there is no point in buying multiple stocks. But yes, for Oil India also, it is very close to its support levels. It was like correcting from the highs of 750 to almost 570. It's a good dividend paying company, and now it is available at its important support levels. And now one thing is very clear that, see, I'm not expecting crude to sustain below the levels of 70 for a longer time. So even if there is any further more fall because of some maybe a positive news flow, then also I'm not expecting crude to fall heavily. I'm of the view that at these levels, Oil India is also a very attractive bid to buy for. Again, we can expect rebound to maybe 700, 750. Currently, it is very close to its 50-day simple moving average and 100-day simple moving average, which is something positive for the stock. So here also the risk reward ratio is quite favorable for those who are like who can take the positional call on the stock.
Okay. Shrikant, a question on something like a Bosch as well, because that's the other one which is starting to see traction of late. And while it is marginally in the red right now, do you think that there's any opportunity, there's a beginning of a trend here as well?
So for Bosch, it is doing really well. And I'm going to say after crossing the level of 18,000, it just doubled in a very short span of time. And the momentum is still intact. Broadly, I'm of the view that any correction, or even at these levels, if there is a long-term view, then we should look for taking some long bets. It is purely based on technical formation. If we consider the support levels, then I think 37,000 and 35,500, these are the two levels to watch out for. But the broader technical pattern is suggesting us that it is heading for the levels of maybe 50,000 sort of levels in next few months. So it will take some time, but it is into very strong uptrend.
Okay. Another one to watch out for is KPIT. I just want to look at KPIT this morning. JP Morgan has an interesting note. They've upgraded to overweight from neutral. Target is now 2,000 rupees. It's an upside of 20%. That stock managing to be in the green. You know, the Nifty IT, of course, in the red, but not half bad. Let's just pull up the constituents of the Nifty IT. And want to get Shrikant's view on whether anything here is something that he is eyeing. In fact, a bit of a recovery on the Nifty IT. And let's pull up the key companies there as well. Wipro worst hit, but Coforge still in the green. Infosys now in the green as well. Shrikant, ahead of the numbers which will come in, quarterly numbers which will come in, because that's where the focus moves now, is Q2, and we'll see that coming in soon. Any positions that you would take on the IT pack?
Yeah, from the IT pack, we like Coforge, but it is very close to its fair value. But based on technicals, I think the stock, it has been consolidating, and now it is trading above its important resistance level of 7,000. So based on its technical formation, the next level to watch out for would be 7,450, 7,500, and in the long run, maybe 8,000. So it's a buy at current levels and more on dips. We also like Infosys. It's our preferred pick to buy for from the large cap companies. And if we see the overall impact on the stock, then it is very minor. Based on, I think, the technical formation, this stock can also move to the levels of maybe 2,050 or 2,100 levels. So these are the two stocks on which we are bullish. We also like Wipro based on its momentum formation. And there also, if there is a positional view, then we should look for adding to the positional portfolio. But Wipro, Infosys, Coforge, I think these are the three stocks on which we are keeping a close watch.
Okay, thank you for that, Shrikant. Coforge, Infosys in focus. Shrikant Chauhan there, thank you so much for joining us this morning. We're going to be talking about one of the big factors that is impacting the markets today. But let's just tell you what those top 5 big factors are and what you're seeing. Deep cut, a gap down. Can the markets really stabilize after this? The number one factor is the Iran-Israel conflict, which has escalated over the last 48 hours or so. Iran has lobbed 180 missiles into Israel. Israel says that they will take revenge and it will be painful. Crude prices have spiked. That's a negative for Indian markets. SEBI's F&O action is expected to impact volumes quite sharply. Up to 40 to 50% is the kind of impact we could see on volumes, and nearly half the traders in the segment now get pushed out because of higher entry barriers. So that's the other big factor. Remember, GST collections have been the lowest in 40 months. That's the number which came in for September. That will be a bit of a downer, with hopes now moving to demand increasing in festive season. FII flows is the other concern. Could they potentially move to China? Because you've seen FII outflows from India. China is making a lot of moves to stabilize its economy. Could flows move there? And I would say below par September auto sales is definitely the fifth big factor which is impacting markets today. But let's talk about factor number 2, which is what SEBI has done. Ashish Gupta joining us. He's CIO at Axis AMC. Mr. Gupta, thank you so much for speaking with us. And of course, you were on the panel which looked at some of those proposals that SEBI has put forth. So, is it harsh, the way that these regulations are going forth? Could a more calibrated attempt have been made, or do you think that this is what's appropriate, looking at the number of volumes and the profile of investors who are coming into the F&O segment?
So, morning, Tamanna. I think SEBI, the guideline they have released has come after due consideration. I think they took a consultation, and if you see SEBI press release, I think they highlighted that they got more than 10,000 people giving their comments, and all were duly considered before coming out with the final guidelines. In fact, if you see the implementation schedule is also calibrated over a period of time, nearly 6 months. So I think SEBI has been quite pragmatic in looking at this space because there was clearly a crying need for action. We have seen, as SEBI has also characterized, the retail frenzy that comes in, particularly around weekly expiry days. And we are seeing this in the market as well. So I'm sure on the shows you see the kind of volatility we have seen in the past few weeks, in the last half hour or last hour of trading, whenever there's a big weekly expiry. And SEBI document highlights that nearly 25-30% of all volumes happen in the just last 1 hour of that expiry. So I think there was some need to rationalize the activity here because it adds both macro and micro risks to the market and the economy.
Mr. Gupta, I wanted to understand from a sophisticated trader point of view, a trader or a participant who actually deals with substantially higher volumes, substantially larger funds in the futures and options space, do things change coming down to November 20th down the line?
Oh, I think the whole aim of the regulation is not really to impact the sophisticated investor. It is actually really to protect the small retail investors. And some of them were getting pulled in because the ticket sizes of some of these option contracts was very low. And in fact, if you see the SEBI data, most of the losses on this trading activity was being borne by actually these investors. And I think what SEBI is trying to do is make sure these kind of investors don't get lured into this activity. And as you would have seen in the SEBI document that came out a couple of weeks ago, even in the last financial year, 91% of retail traders actually lost significant amount of money. I don't think there is going to be an impact for the sophisticated investor, but for the fact that the counterparty, which is the small retail investors, hopefully will not be as meaningful as was earlier.
Ashish, was one way of doing this then identifying who could trade and have a filter, say on income tax returns filed, or those kind of parameters? That because if you wanted to keep small investors out, then define and then target small investors from staying out. Was that one way to look at it, or was this the best way? Because this is a more broad-based kind of an action, including reducing the number of weekly expiries.
I think the challenge with some of those measures is really how well they can be executed, right? So, where does the control lie? So, it has to be declaration based, and there are obviously challenges, in India. How many people file income tax returns? How many people can have an account, and if someone else trades on that account, so how do you really implement those? So there are several suggestions, and I'm sure SEBI will look at those, whether there is sophistication in terms of knowledge of the investor, minimum threshold of whether net worth or, as you said, income. But really, some of those look better on paper, but really implementing them is very challenging.
There's always the element of human behavior and needing to take that speculative stance when it comes to equity markets. Now that this avenue moves out of the way, do you think that there could potentially be a shift towards relatively smaller stocks once again in the cash market? Do you think that there could be some changes that potentially that segment of the market that would undergo this?
Sure. So I think SEBI in their statements have spoken about the fact that they also believe that speculative element is an integral part of the market. It has really several positives in the way it backs capital markets, whether it's in terms of liquidity or price discovery or arbitrage. The idea is not to kill all speculative activity. In fact, if you see on single stock futures and options, and in particular options, SEBI a few weeks ago has actually come out with the detailed guidelines, which will allow even more stocks to come into the ambit of single stock options. What here is being looked at is really one particular segment, and this relates primarily just to index options, right? And that too just a weekly expiry, and within weekly expiry, the frenzy trading that happens on the expiry day. So I think that is what SEBI is looking to do. It wants more participants to come into the market, and if we look from a medium to long-term perspective, we want investors coming into the market to get a good experience of the capital market, right? And if you see the numbers that were put out in the SEBI report a few weeks ago, in the last 3 years, nearly 1 crore investors on average have lost about 2 lakh rupees. And that is a very significant amount of money. So that's about 2 lakh crores of losses for retail investors. And most of these investors are less than 30 years old. So that's not really the experience of capital markets we want to give to our young investors. I think
what do you say to those who argue that these investors will then move on from derivatives to maybe online gaming or to online lotteries or to dabba trading, because money will find its destination, isn't it?
Yeah, so I think if you look at the online gaming industry, it is already about 10x the options market, right? And actually and I personally would not want our capital market players to really come in and see this as equivalent of online gaming, right? The fact that online gaming is growing at a pace, that is a separate matter of concern, and 300 million people are already active there. That is another issue of concern, right? But I think the fact that about 40 million people are actively trading derivatives in this market and incurring this magnitude of losses is really what we need to control.
All right, Mr. Gupta, we'll leave it at that. Thank you so much for joining us and giving us perspective on the latest changes that have been brought forward by the SEBI as far as the futures and options space is concerned. Again, this is something which is developing, and we'll get a much better idea of how markets are going to take this on come November 20th and after that. But with that, let's shift focus to the festive season. Well, even as it gets closer, we have Bank of America, which has come out with a note, and they're expecting, and what they're expecting from the season. We now have Mahima joining us again to give us highlights of this. Mahima, back to you.
Right, so BOFA on festive demand, they sat with Datum Intelligence and they've come out with key details as to how festive trends will play out. They're expecting a sales growth of 23% YOY versus 16% last year. Now, spending in customers' mind is on the uprise, and 65% of online buyers indicate spending more. And 60% of users are set to spend more than 50K this year, which is much higher than that of last year. And around $12 billion gross merchandise value will be generated via online commerce platforms, and 1 billion out of this will be done through quick commerce. So what they're saying is that quick commerce players will drive growth, and festive spending done offline earlier may move towards the quick commerce side more this time. Now, in terms of festive trends, they expect strong momentum for Zomato, and this could be a good catalyst for Zomato as well. And in terms of festive trends, 3 waves are being observed. First one being users are curbing spending 2-3 months prior to the festive demand so that they can purchase more in festive season, and products are also being purchased on credit. Plus, users are willing to spend more on fear of missing out of offers as well as discounts. Now, in terms of consumption trends, what they're seeing is that consumers are spending more on discretionaries like travel as well as entertainment, and discretionary spending is coming at the cost of retail purchases is the common observation. And spending on restaurants have come down, and people are trying newer things in fashion. When it comes to brands as well as ticket sizes have changed overall in terms of fashion. In terms of sales trends, smartphones are seeing no longer the kind of traction that they used to, because the upgrade cycle has the life cycle of a smartphone has now become longer. In terms of groceries, festive share will grow up to 13% versus 10%. Electronics also, pre-spending limits are strong in terms of festive demand, and quick commerce will dominate more than 50% of online grocery sales. And in terms of what categories will boost? Well, it's the beauty and personal care, stationery, smartphones. In terms of fashion e-commerce also, fast delivery and limited selection will be on the focus. And in terms of the FMCG brand, growth via quick commerce, bigger SKU sizes will be seen growing. And in terms of kiranas, they'll be impacted by quick commerce as well as dark stores. And overall, of course, this is not from the BOFA report, but overall stocks that one can, keep an eye on in terms of festive demand trends. Well, jewelry stocks like Senco, Kalyan, Titan, PN Gadgil. In retail, we'll have stocks like Trent, Raymond, Brainbees, V-Mart, Ethos. In QSR, we'll have stocks like Sapphire, Devyani International, as well as Jubilant Foodworks. Snacks, we'll see Gopal Snacks, Bikaji. Paints will also be in focus. Hotels will also be in focus. Of course, airlines in terms of tools and travel will also be in focus. And stocks like Ease My Trip, Thomas Cook could see some traction. Lastly, even autos will see some kind of uptick in terms of vehicle sales. And consumer durables like Voltas, Blue Star, and EMS like EPAC, Sirma, and Dixon could also see a lot of traction when it comes to festive sales.
Thank you for that, Mahima. And let's talk about Dixon. We are kicking off the festive season. Markets are not very festive right now, but that doesn't take away from the fact that the festive season is when a lot of big expenditure is focused. And Atul Lal, MD of Dixon Technologies, is joining us. Atul, great to speak with you. And I know we're going to only focus on the pre-festive season point of view. You can't talk about your numbers, etc. That is understood, but nevertheless, thank you, because we're just trying to understand what is the demand traction that you have been seeing at your end in all the different categories.
See, festive season is the most important season for consumer durable industry, and so is the case for Dixon. So undoubtedly, the second quarter is the largest quarter for the industry. We are in 9 businesses, and we are seeing extremely good traction in the smartphones, which is a large business for us. We're also seeing an upside on wearables. We're also seeing positive growth in televisions. In lighting, I'm seeing normal situation. In washing machine, it's slightly subdued on the semi-automatic side, but extremely good growth in fully automatic top loading. So that's the situation. I'm very sure with Navratri kicking in from today, it's going to be a good season for the industry.
Mr. Lal, you know, what we've actually seen over the past few months and past few quarters is that home electronics specifically is one of those sectors and segments which hasn't been as, upbeat as compared to several of the other segments. I reckon that to a certain extent, the slackness in semi-rural areas as well as to tier 2 towns, the demand has not been as substantial. Do you think that the upcoming festive season could potentially change that? What are your partners giving you an idea of? What kind of traction are you seeing? What kind of feedback are you getting from your partners here?
You see, in home electronics, undoubtedly, television as a category is under pressure. The demand has been subdued. Festive season, there is definitely an uptick. But on an overall basis, the demand has been subdued. In washing machines, as I just shared with you, the demand for top loading, which is more premium kind of product, has definitely been extremely positive and good. We entered a new category of refrigerators in which within 4 months, we are hitting almost 90-95% of our capacity utilization. So I think it's a mixed kind of a bag. In herbals, demand this year has definitely recovered. So I think it's kind of mixed kind of a bag. In certain product categories, it's good. Premiumization is happening. It's supporting the demand in that particular product category in those domains. In some of them, like televisions, overall as a category, the demand is subdued.
Mr. Lal, what about the mobile segment? That's, of course, the mainstay. And just to take off from what you said in your first response to us, that festive season is important for a lot of companies, including for Dixon. If I were to ask you to hive off contribution to annual revenue just coming in from, or sales coming in from festive season, what would that number look like? And then give us a bit of a sense of what's happening on the mobile segment.
So responding to the second part of your question first, mobile segment for us is the largest piece in our revenue contribution. And we have had a tremendous run in this particular domain in the current year. There has been extremely aggressive growth. The order book is very, very healthy. We've had a good run. The contribution of the festive period, which I consider almost 4 months, from July to October, in Dixon's case would be almost 38 to 40%. It's a large contributor to our annual revenues.
Okay. I'm just wondering if there is any impact at all that you're seeing of the new iPhone launches. I know you make all the others, all the major ones, but since we keep hearing that that's like a super hit product and their sales are booming, I'm just wondering if there's any impact for you at all.
Well, we are practically servicing all the major brands in the Android ecosystem. And what I see is that their sales is extremely, extremely robust. So I know that there are reports of iPhone success. Now, is it having any impact on the Android ecosystem sales? And we are shared with practically all the brands. I don't think so. I think all of them are doing extremely good in the current season.
Okay. I want to talk to you about laptops. You have 4 major brands now, and we spoke, Mr. Lal, just a day before I think your 4th brand was announced. So now you have 4 major brands. Has the appetite been, encouraging as far as you're seeing for this segment?
So it's a very large addressable market.
Yeah.
We appreciate the market size in India is almost $10 billion. And for us, it's going to be the next trigger of growth. A new campus is being set up in Chennai. We have an aggressive target for launching commercial production there in Q4 of the current fiscal. And we have all the top 4 brands with us. We have HP, we have Lenovo, we have Acer, and now we have Asus. So we are targeting to start production for most of them in Q4 of this year or Q1 of the next fiscal year. we are extremely bullish on this particular category. A lot of work needs to be done. It's not a simple product line for any company, but we are extremely gung-ho about this particular product category.
In terms of demand coming in for laptops, and let me add wearables to that as well.
So what my sense is that demand in this particular product has not been very aggressive in the current fiscal. But from Dixon's perspective, we enter into this as a new category. So any incremental revenues is a significant positive for us. And since we are a B2B company, the main focus for us, apart from being a part of growth categories, is to get a larger share of the customer's wallet and also keep on acquiring new customers. So I'm fairly confident that this is going to be an important domain for us.
You see your clients and customers going up the value chain, and based on the kind of partners that you are working with right now, do you think that in the long run, what sort of an impact can we see in your operating margins on a consolidated basis? And at what point in time, a year down the line, a couple of years down the line, do we see a meaningful improvement in your operating margins?
You see, EMS industry globally, if you compare us, we are operating at similar margin profiles as our peers do, not only in India, but globally. So I can't talk much about it because this is a silent period. But please be rest assured that absolute numbers growth is going to be extremely good. When you look at margin as a percentage, it's going to be in a similar range.
Okay, thank you so much, Atul Lal, for speaking with us, and wish you a happy festive season as we are for all of our viewers.
Thank you.
So Dixon Tech talking about how this is a very important, part of the segment for them. In fact, contribution of festive period to revenues between July and October is nearly 40% just for Dixon Tech, and that's a good parameter. They are in 7 to 8 categories, so can't think of anyone better to really come out there and tell us what they're expecting from the festive season. Home appliance is looking dull. I thought that was an important one to take away from what they're saying. Okay, we're going to be continuing that conversation. We're going to be speaking with Blue Star next as well, because we want to get you a comprehensive piece on what is happening in the festive season. But meanwhile, there's a new listing on the block, new kid on the block. And what a cute picture there. This is actually a kid who's going to be ringing the bell. Agam, KRN in focus.
Yeah, and it's actually had a very, very strong subscription as usual, as is the case for a long list of IPOs which have come through. And we're most likely to see a premium here as well, but it's a wait and watch. We'll also have to see the kind of impact your overall market sentiment can potentially play on this particular listing. But you will soon have your updated rates on screen, and it does seem like it could potentially list at a premium. Whether or not that is the case is a wait and watch. We are waiting for the rates to come up for you on your screen. The first rates should have fallen. And there you have it.
Wow.
Well, double.
Someone's having a good day.
Yeah.
So at least KRN Heat Exchanger, and this also had a 200 times kind of a subscription.
Yeah.
So KRN Heat Exchangers 209 to 220 was what the price band was, 460 rupees, 109%. So yeah, double your money. No wonder the primary market is so hot, because people see this and then, they're hoping that this is the kind of experience that they're going to have. At least the first few minutes for KRN has been completely fantastic. All right, some good news in an otherwise tough day. Quick look at where the markets are before we wrap up on India Market Open. The Nifty still down about 230 points, holding up about the 25,500 market. That's important as far as the Nifty is concerned. The Bank Nifty also down about 1%. IT stocks relatively not doing too badly. Your biggest hit, I would say, is on your real estate side. Your real estate index is the biggest loser there. Metals are also doing relatively fine, but the Nifty reality down about 2.5% now. Metals actually in the green, led by JSPL, Tata Steel. That entire pack is doing fine. And of course, the new kid on the block, KRN Heat Exchangers, is listed at a premium of 118%. With that, it's a wrap on India Market Open, but stay tuned. Next is Talking Point. We're also speaking to Blue Star and focusing on what the festive cheer will look like. Welcome, you're watching Talking Point. We are today looking at a tough day for the markets because of a whole host of factors. But having said that, the pain point on the Nifty is contained above the 25,500 level. Still about a % cut. In the larger picture, not that bad considering what we've seen in the last few days. The big focus for the markets though, now we'll also move to the festive season. It kicks off today in a sense with Navratra at least kicking off today, and demand is expected to improve over the next couple of months. To speak more on that, I'm joined now by B. Thiagarajan, MD of Blue Star. Mr. Thiagarajan, very good morning. Thank you so much for speaking with us here at NDTV Profit. Always a pleasure to have you on. Let's.
It is wonderful to. Good morning, Tamanna. It is wonderful to interact with you.
Lovely. Let's begin with, how you're looking at the season pan out. Consumer durables and especially home electronics have had a bit of a subdued couple of months. Do you expect that to pick up? What are the early trends you're noticing?
That's not the case in air conditioners category. You're aware we had an excellent summer season. Which grew more than 50% this year, an unprecedented growth. Post that, the demand continues to be good. It's not at the same level as summer, but we are seeing a continued demand. I would say the air conditioner category is witnessing huge demand across the country, including Tier 3, 4, 5 markets. We look forward to an excellent festive season.
Mr. Thiagarajan, just want to understand whether or not weather conditions in this case are also one other important factor which is pushing sales for air conditioners. Is that one a big factor in? And also, If you could just give us an idea with respect to e-commerce and the kind of role that it's playing for sales, as well as quick commerce now. Suddenly, we're all talking about instant sales where, appliances show up on your doorstep within, minutes. How do you see all of this panning out here?
Agam, good morning. The demand part of it is happening basically. The penetration levels are lower. It is somewhere around some 7 to 8%, and it has to move up. It will more than double within next 4 years of time, and so it is driven by that. Second is the urban heat effect. Even in smaller towns, the temperatures in summer season are unbearable. In the rest of the year, it is the humidity that is causing the issue. The homes that are constructed or the apartments that are there do not have any cross ventilation. The next part is connected with the power bill itself. Thanks to the energy labeling program, over the past 15 years, the energy efficiency has been improved dramatically. So if you would have bought an air conditioner in the year, let us say 2000, today it will consume only 20% of the power that it consumed in year 2000. So therefore, running cost is no longer an issue. Then, unlike other categories, air conditioners at a home are consumed more than one. It could be 2 or 3, depending on the apartment or the customer. Now, given this, the demand continues to grow, and most importantly, thanks to the PLI scheme and other initiatives of the government, local supply chain has developed dramatically, and therefore the prices and supplies are kept at affordable level. These are the reasons for demand growth. Coming to the channels, as is the case in most categories, many channels coexist in India. So the modern trade or the power retailers, regional power retailers, and other retail stores, distribution networks, and then e-commerce and the quick commerce, all of this are going to coexist. And we are also witnessing convergence of the buying patterns here, because the consumer is using the internet to do his preliminary research on buying a product like air conditioner, and therefore his expectations from the channel remains the same. Let us say in e-commerce, the price drops due to a sale. Within seconds, the consumer is aware this is the price at which, and therefore the dealers demand this is the price at which I will sell.
Mr. Tyagarajan, just to understand, sir, so what is the expectations? Can you quantify that from the festive season? What is the expectations to revenues that you're going to see, since you already had a fantastic summer, and that is, I would say, peak season for you for your segment. But in festive season, what is the kind of revenue increment that you're seeing?
I think it started with Onam. Onam was not that great because of Wayanad incident. I can very well understand that. But going by what is currently happening in the market, I think easily 20% growth is possible during the season, starting today till the new year.
Mr. Tyagarajan, there were issues with respect to supply chain in the first quarter. Have things eased up since then, and could there be a better improvement, rather better performance based on that in the second quarter?
It has eased out. At least Blue Star lost some sale in the month of June last year. Basically, we couldn't cope with, because the April growth was around 70%. May was again 70% growth. But right now, there is no constraint in terms of supplies at all. And there is no over inventory as well, because with the local supply chain, you are able to plan properly. The inventories are in components, because there are still supply chain disruptions in receiving the components from various sources.
Okay, just one last question, sir, and this is not on festive season, but this news came in. So I just wanted your view on it or any clarification if you'd like to give that this company, WJ Towel & Co., filed an arbitration proceeding against you. You had a filing saying that these claims are unsubstantiated and no financial impact, no material financial impact. Can you give us some information on this? What is the size of the arbitration proceedings that they're demanding?
So this is a shareholder agreement we had entered into for electromechanical projects business in Oman. It was way back in 2015. And in July 2023, there was an arbitration proceeding that was initiated. The original claim was something like rupees 2,024 crores. And yesterday we received a claim amount of rupees 462 crores as against what was 224 crores. Either 2,024 crores or 462 crores, all are frivolous. And these are not defendable by the party, and we are defending ourselves. And there is not any financial impact that will be on Blue Star at all. We are more than confident in this matter.
Okay, Mr. Tyagarajan, we'll leave it at that. Thank you so much for joining us and taking us through how things are panning out for the quarter and what we can expect going forward into the festive season. And with that, we shift focus to yet another topic that we have been talking about since morning. But to take us through that, as well as what we can expect from markets going forward, we are now in conversation with Anand Shah. He's the head of PMS as well as AIF investments with ICICI Prudential. Anand, good morning and thank you so much for joining in. I want to take stock of the markets firstly at the moment, what you make of them with the place at which we are right now, and how things could potentially move on from here on.
Sure, thank you. Good morning. Thanks for having me here. So I'll give you a little bit of cliched answer that, look, the expectations from market will have to be far more muted than what we have seen in last few years. Yeah. And the reason being, look, when we go back to 2020, we were also, we had quite a few inefficiencies in the market. More importantly, we had a subdued 5 years in the market. So we were starting from a low point in terms of past returns. And that generally is very good news for the future returns. Right. Now today, as we speak, we are sitting on a very hefty profits on the market. Yep. But I think more importantly, we had almost a decade of consumer-facing businesses doing very well, and manufacturing allied businesses doing relatively soft growth, and to that extent, market was fairly skewed also. Yeah. So not only market was inexpensive, but within the market there were inefficiency where consumer-facing businesses were darlings. They were like at a very high PE multiples, price to book multiples. In the same time, you had this old economy / manufacturing businesses were trading relatively cheap. Yeah. Now that inefficiency is also fairly reduced. The consumer-facing business still remain more expensive than manufacturing, rightly so, but nevertheless that gap has reduced. Right. So in that sense, the inefficiency in the market over the last few years have reduced, and that means that there's so much less money to make in the market incrementally.
Yeah, but that's not what people are experiencing or seeing, Mr. Shah. They're looking at the primary market. We've had a bumper listing today, and there is that excitement growing, more retail investors coming in, and then you have what SEBI has gone and done, which is try to curb some of that froth, at least in the derivative segment. What is the impact for other investment avenues? You, of course, look at PMS and AIF, but more traditional avenues, equity, cash market for mutual funds. Do you think some of those flows then now come there?
No, I think that's a good news. The good news is that across the board, market participants, bearing few, are cautious. So you hear fund managers from mutual fund, you hear distributors, you hear even, when we meet investors, people are fairly cautious. People are saying, look, we want corrections. And rightly said that the regulator is also conscious of the risks that are sort of increasing by the day as the retail investors become fairly more confident on the market today than they were 4 years back. So I think that's a good news to me personally. I believe that makes it much more healthier. To be very honest, a correction would make the market much more healthier.
Which is what we're possibly seeing now.
Yeah. So I think in that sense, I'm looking at all these developments more positively than negatively. Having said that the market is not obscenely expensive, there are frothy part of the market, and that froth has to be, in a way curbed to protect the retail investors who would otherwise get sucked into those schemes. So I think all in all, I look at these steps as more positive for the markets if that leads to a market correction. I think that's the key. A market correction would be more healthy than anything else.
What does a correction look like to you is then my next question. We're sitting at about a 1% cut right now, and frankly, it's not necessarily a correction. What is your definition of a correction?
So again, you'll not like me for saying this, but in the 34 years of history that we have seen, markets used to correct very healthily, used to correct more than 20% every 13th, 14th month on an average, and market used to correct almost 10% once, twice, or maybe thrice a year. That something is missing. We are not seeing deep corrections in the market. Since 2020, we haven't seen a 20% correction, and we have seen only one 10% correction. So I think we would want to see, before committing money convincingly into the markets, maybe a 10 to 20% correction. Wow. That's something which would make the market that much more safer.
Anand, there are a lot of people who've been waiting for that and then looking at markets going in the opposite direction and wondering if they missed out. Is that a risk you're willing to take?
So again, that's the other thing we have been telling everybody. Don't wait for the market corrections. You need to have your asset allocation in place. Mm-hmm. So don't just sit on cash because you're convinced that the market is going to correct. Market might correct a year later, 1.5 years later also. My point being that a healthy market would generally tend to correct every now and then. Mm-hmm. It'll make it more healthier, but that doesn't mean the market corrections are imminent. Because if you see last 5 years, 4 years, while the markets have done well, corporate profits have also done very well. Right. If you see profit to GDP for Nifty 500 has moved from something like 2.6%, 2.4% to 4.8%. Nifty 500 PAT growth CAGR for last 4 years in excess of 30%. So you have tailwinds also. Yeah. More importantly, as we see, you have US, you have Europe, and you have China. 3 largest blocks of economy is cutting interest rates together at this point of time. So it's not imminent that market will correct. My point being that one needs to be cautious in the market at this point of time and focus on asset allocation. Neither side. You need not be on 100% cash, you need not be in 100% equity.
Yeah. Right. So Anand, let's assume at the moment that we do in fact see not a deep correction as 20%, maybe about a 5-6% on the benchmarks. Naturally, your broader markets will see in that case about a 15 to 20% correction. These are all assumptions. But there will always be companies out there, or rather sectors out there for now, which are on the trend of giving you growth rates of around 15 to 20%. What are those areas that either you'd want to remain invested in, or that you'd potentially see better prices available and then you'd want to perhaps park your funds there? What are those areas that you're keeping an eye on right now?
Sure. So before I come to this, I think one more additional data point would be good to see that when we are looking at this number sometime in the 3rd week of September when market touched new highs, there are only 95 stocks out of Nifty 500 which were within 5% of the all-time high. Right. So the market's already correcting internally. Right. We have more than 250 stocks in Nifty 500 which are more than 10% down. Some of the stocks are down more than 30%. And many of the sectors like PSU banks and others have peaked way back in June. Sure. They have not touched the new highs. So I think market is in a way also correcting while it's touching new highs internally. Coming back to, I think, what we like today in the market, we still like the manufacturing, again, more bottom up. As I said, the inefficiencies at the sector level, at the market level, is not very high to say that I like this sector as a whole. Barring banking, where both private banks and PSU banks, after the near-term consolidation and underperformance to the market, looks broadly okay. But beyond banking, when we go into other sectors, will be more bottom-up. We like space like manufacturing allied businesses, be it cap goods, be it power utilities, T&D, transmission. I think everywhere we are seeing bottom-up opportunities to still participate in the growth. Within consumption, we've been underweight products, but the services. So I think there's a clear trend, and that's seen globally, that as per capita income moves, the consumption pattern moves from products to services.
So you mean like a Zomato kind of or more of a premiumization kind of a situation?
One, when I'm saying services, it includes travel, restaurants, education. But also, rightly said, that within the products also, the way we are consuming is changing from unorganized to organized. So our portfolios have more of this consumer services business than the products. Products, I think the penetration has happened. The larger middle class, the way is shifting, and we are sort of tracking that into our portfolios.
How are you feeling about IT right now? I mean, is this the turning point? Has it come? I'm curious to know your view ahead of, we of course see the quarterly numbers, but the rate cut was one big factor that has come in. We'll know what happens with the US elections, but what's the view on IT?
I think IT, we've been underweight for a while now. So IT had a big bump up, both in growth and valuations during the COVID time, 2020, 2021. And since then, we've been sort of underweight, knowing or thinking the way we believe that the growth rates cannot be as good and the multiples cannot be that high. But trust me, till then, there's not a single month, not a single day when people have not asked me about IT. So to be very honest, IT has never gone out of flavor.
So that's why the smile when I asked you, because you're like, I was waiting for that question.
So yes, IT has been the strong businesses. They generate a lot of cash flow. Unfortunately, they don't have a lot of growth opportunities to invest that cash flow. So that cash flow is being used to pay out dividends, do a lot of buybacks. So in that sense, IT sector to me is more of a slow to medium growth industry from here on. And for that, the valuations continue to remain rich. So I haven't found valuations attractive enough for IT to plunge in, but otherwise very, very strong businesses and balance sheets.
Anand, my question is on a fundamental basis. When you construct a portfolio now, I'm assuming that you have a portfolio of about 30 stocks. The first one is that at this point in time, when markets are at where they are right now, would it be perhaps a little bit more better to have a concentrated portfolio where you actually bring down your number of stocks to 20 or 25? And again, I'm just talking about ballpark numbers. And secondly, do you think that it would be perhaps a little bit more pertinent? So for example, if you allocate about 5% to one large cap stock, would you prefer to perhaps increase that allocation from 5% to 7% towards large caps on an individual basis? Is that, would you think that would be probably a better way to go about now that markets are at extremely heady levels?
So again, I think more important question, it's not 25, 35 or 45 stocks. There is a merit in diversification, nothing wrong with that, as long as you know those companies are worth buying.
Sure.
So to be very honest, the important question is, do you understand the business you're buying in? Do you believe or trust the management that's backing that business? I think we have this BMV model. We look at business, management, and valuation. We need all the three in place. It's not either or. We need strong businesses which can survive a downturn, can thrive in the good times. We need managements which are capable and the corporate governance issues are addressed. And last but not the least, valuations. So I think we are looking at all three. The number of stocks where we are more convinced today might have reduced, given that some of the stocks would have become fairly expensive. And to that extent, maybe we have a little more concentration, But I don't think that's the advice I would give to anybody and everybody.
No, fair enough. Yes.
It needs to be well researched. Yeah. If you don't have research, then you're better off owning more companies than less.
Sure. Yeah. Sure.
The concentrated portfolio is much more riskier,
right,
and needs much more research than otherwise.
Yeah. Are you over the PSU run up? Or do you think that there's some potential there? I mean, the big theme of, say, like 4-5 months ago has sort of fizzled out for now. Do you see some interest coming back there?
I think corrections have been fairly stark. Some of them have come into buy zone. But again, as I said, even within the sectors we like, we are more bottom-up. Ditto for PSU. I think there are still companies within PSUs which might not have strong fundamentals or might be very expensive. So I can't say generally for PSUs, but we own quite a few PSUs in our portfolio, and we have been sort of incrementally looking if some of PSUs which we have sold, have they come back into a buy zone, and we continuously evaluating that.
So it's a wait and watch. Apply those filters carefully, especially right now. Aruncha, I think the big takeaway that the cut is yet to come and could be 10 to 20%. We haven't seen that for a while. Do we see that or not is the big question. Thank you so much for joining us today at the NDTV Profit Studios. Pleasure to have you on.
Same here. Thanks.
All right, that's all the time we have on Talking Point, but stay tuned. All of the market action continues after this break on NDTV Profit.